Today, we are going to be covering Social Security timing and various strategies with that. Before we dive into the various frameworks on how to approach Social Security timing and the benefits of different strategies, we're going to lay a foundation for why timing matters. So, some of these things you probably already know, and it'll be a refresher if you do. If not, this is really key information for everything that we're going to be discussing today. So for those that are unaware, your Social Security benefit is calculated based on the number of working years that you had, your highest 35 working years that you contributed taxes into the system. There is a benefit formula that is used based on those 35 years where the Social Security Administration calculates your primary insurance amount. They call that the PIA. That amount is an amount that you receive per month, and it's indexed to an age that's called the full retirement age, or FRA. The full retirement age for individuals ranges somewhere between age 60 and 67, depending on your birth year, and that's really the anchor point for your benefits. The reason that timing matters is because adjustments are made to your FRA payment amount depending on when you claim. If you claim at FRA, you're going to receive your PIA. If you claim early, you're going to have penalties for claiming early. If you delay or claim late, you actually receive benefits for delaying. So should you claim? Should you claim early, on time, or late? That's the big question and why timing is so important. So before we dive into the various strategies, let's talk a little bit about the penalties for claiming early and the benefits for claiming late. So as I had mentioned, the starting point for your benefit calculation is that PIA amount that happens at FRA. For every month that you claim early, so let's say your FRA is 66, if you claim at 65 and 11 months, that is 1 month early, you're going to receive a reduction of your monthly payment of 5/9 of 1% per month, roughly 0.5% per month. And that's on the first 36 months. So if you claim 3 years early, you're going to multiply 36 months times 5/9 of a percent, multiply that by your PIA, and that's going to be your monthly payment amount. So there's a reduction if you claim early. If you claim even earlier than 36 months, the penalty is actually 5/12 of a percent per month, so it's a little bit less. And if you claim at the earliest possible age and you multiply all these early benefit penalties, you end up with approximately 30% less for your monthly lifetime benefit compared to the FRA amount. So that's the penalty for claiming early. Now, that does not automatically mean that claiming early is a bad idea. This is just how the Social Security Administration has laid it out for those that are claiming early. Conversely, there's a reward for claiming late. If you delay past FRA, so rather than claiming at age, let's say 67 for your FRA, if you wait till age 68, you receive roughly 8% more per year for delaying your Social Security. And you get that on an annual basis in terms of your monthly payment increases. You could do that all the way up to age 70. Once you hit age 70, you can no longer continue to accrue that 8% gain per year. So if you wait until age 70, depending on your FRA, it's somewhere between a 24 and 32% overall increase to your monthly Social Security amount. So there's a benefit or a reward for claiming late. The difference between these two extremes can be a whopping 76% difference in payments. So the difference between claiming at age 62 and claiming at age 70 is 76% different per month in the payments that you receive. So it's pretty dramatic in terms of how much you can receive in total. So how do we think about when to time Social Security? When should you start claiming your benefits? I'm going to provide today 4 frameworks that we'll work through to help you think about when and how to claim your Social Security. The first one that we're going to cover is mathematically based, and it is a break-even analysis based on your life expectancy. If you claim early, you actually are receiving cash, obviously, when you otherwise would not be if you were delaying, and that cash accumulates. And it takes a while for that increased delayed benefit amount to catch up to the amount of cash that you've foregone when you were waiting. This break-even analysis, we're going to talk about what age do you break even on delaying versus claiming it early. That's a really important point. The second thing is not mathematical at all. It has to do with lifestyle choices. So we're going to talk about some reasons why you may think about claiming early or late based on lifestyle choices. The third thing that I also think is extremely important in terms of making your decision is your confidence in the Social Security program. We work with a lot of different clients, as Robert had said, hundreds of clients across many different states. Different people have different levels of confidence in the Social Security Administration program. Depending on your confidence level can also impact when you claim. And we're going to talk too a little bit about the solvency of the program and some key metrics that are really important when you look at how much confidence you should have in the program. And last but certainly not least, there are some advanced strategies. There's many, many different ones that apply to very nuanced situations. We're going to cover a handful of those today, particularly ones that have to do with spousal arrangements, Roth IRA conversions, divorces, and then also WEP provision that was eliminated in 2025. But some of these advanced strategies can actually override the other three because they're really, really valuable if they pertain to you, but they don't pertain to everybody. So these are the four key frameworks that we're going to look at for analyzing when and how to claim your Social Security. And we'll start with the mathematical analysis. And this is a break-even analysis. So framework number one. Basically, what you want to do when you're comparing a break-even analysis is you want to compare the cumulative benefits you receive under different scenarios. For example, if you claim at age 62, by the time you're age 65, you're going to have accumulated, let's call it $40,000. So your cumulative benefits by age 65 is 40,000. If you compare that to claiming at age 70, right? By the time you're age 65, if you haven't taken anything out, your cumulative benefit is zero. So at age 65, the cumulative benefits of claiming at 62 are obviously better than the cumulative benefits of claiming at 70 because you haven't even started yet. But every single year that you analyze that, the cumulative benefits change and delaying starts to catch up. It starts off behind, but it will start to catch up because the payments are bigger. And the question is, when does the cumulative benefits of waiting surpass the cumulative benefits of starting sooner? And what you really want to do is identify a break-even age. For most people, this is somewhere between age 78 and 82, but this varies depending on your investment assumptions. It varies depending on COLA adjustments and many other things. But this break-even analysis is the mathematical approach that you should take. Taxes also, by the way, play a pretty big role in this. We're going to walk through an example of this break-even analysis because I think it'll be really illustrative for helping to understand this point. So we're going to compare a hypothetical situation of claiming at age 62 versus claiming at age 70. So we're looking at earliest possible versus latest possible. Under this scenario, we're going to assume that there's a full retirement age of 67 for this particular individual. Their primary insurance amount is $1,900 per month. If they were to claim early at age 62, they may take a 30% reduction, but they will start receiving this $1,330 per month every single month. Conversely, if they wait until age 70, that $1,900 benefit may increase to $2,400. So there's the very large difference in your monthly benefits depending on when you start claiming. However, what we want to analyze, as I mentioned before, is the cumulative benefit at various different ages. We're going to start at a really interesting age, which is age 70. The cumulative benefit for someone who starts claiming at age 62 on their 70th birthday under these conditions is $162,000. So that's how much they've collected over that 8-year period from their monthly payments. The cumulative starting value at age 70 for someone who's starting at age 70 is obviously zero. So this difference here of $162,000, the delayed benefit needs to catch up to that amount. You have to make up that difference. And obviously, it's generating almost $1,000 more per month in income in this particular scenario, but it's starting behind $162,000. So how long does it take for the age 70 benefit to catch up to the age 82 benefit until the cumulative amount is equal? And that is your break-even analysis. So if we take a look here at age 84, the person who claimed at age 62 has received roughly 460,000 in benefits. And the person who claimed at age 70 has received roughly 460,000 in benefits. So if you claim early or you claim late, by the time you're age 84, it's roughly identical for the amount of cash you will have received from the Social Security Administration. This is your break-even age. If you're anticipating a life expectancy well beyond 84, that would be an argument to delay taking your Social Security. If you're expecting a life expectancy that's potentially less than 84, then that'd be a reason to claim earlier. And if you're expecting it right around 84, I personally would recommend claiming early. The reason for that is even though this is equal at age 84, if you do pass away, at age 70 because you got hit by a bus or something like that, you would have left $100,000 on the table because of that unfortunate event. So all things being equal, you may as well take the one that provides some downside protection, if that makes sense. So, but this is an example of a break-even analysis. There's actually even more complexity to this. For example, your tax rates may change over this time period. For a lot of people, even though this cumulative benefit for 70 may not be as high as it first appears compared to the cash that you're collecting at age 62. The reason for that is for many individuals, when they turn age 73 or 75, depending on your age, RMDs kick in. And so they actually get taxed higher. So you've delayed this benefit, but now it's getting taxed at a higher rate. And so there may be some advantages there to claiming earlier when you're in a lower tax bracket. So this is an example of a break-even analysis without factoring in taxes and some fixed COLA adjustments, et cetera. But it's a really good framework for thinking about when and how to claim Social Security. The next framework that we're going to look at, this has nothing to do with the mathematics of the break-even analysis we just did. This is a completely separate thing. It has to do with your confidence in the Social Security program. And I do think that this is a really important framework for people to think about and decide where they fall on the spectrum in terms of how confident they are in the Social Security Administration program. A little background about the program. So taxpayers contribute into this. This was established in 1935 in the midst of the Great Depression. And originally, the idea was to help fight elderly poverty, and taxpayers were going to contribute to this, and then beneficiaries of the program, when they reach a certain age, were going to receive payments out of that Social Security account. And in theory, this basically worked like a giant pension for the United States, where everyone was required to contribute. The government would manage it. Beneficiaries would make claims once they hit a certain age. And so that's how the program was designed in 1935. This Social Security account was supposed to be there and accumulate, and it was supposed to be appropriately funded over the lifetime of the program. Where we sit today, there's some really important data when you think about if the program is going to continue in its current form or if there's the potential for changes to occur. So some things that are important data points. Back in 1945, so 10 years after the program had been established, the number of workers per beneficiary, or basically the number of people contributing to the program compared to the number of people drawing on the program, was roughly 42 to 1. So 42 people were contributing for every one person making draws. Fast forward 80 years to 2023, the current ratio is roughly 2.7 people contributing for every one person making draws. This ratio is substantially less than when the idea was originally put into place. I'm sure that the administration back in 1935, when they created it, looked at this ratio and probably said that's very tenable. We can take care of this elderly poverty problem we have during the Great Depression with this program. If you look at the ratio today, where we only have 2.7 tax-paying workers for every one person who's claiming benefits, that is radically different than how it was originally established. The future projection is for that to drop even further by 2035. This next slide is also really interesting and very telling. So the Social Security Administration program has this account that generates, well, it's supposed to have an account that would generate interest income on behalf of Social Security beneficiaries. The Social Security Administration Board of Trustees publishes an annual report every year to talk about the solvency and balance sheet of the Social Security Administration program. In 2010, in their annual report, the Social Security costs of all the beneficiaries being paid exceeded the interest income from the Social Security account for the first time. So that really kind of marked the beginning of financial strain. It was kind of obvious before this, but the program was beginning to get strained because now interest income was no longer covering the payments required for the program. We move forward 11 years from that first date. Now the total program costs surpass the total income. What that means is the total tax revenue brought in for Social Security plus the interest from the Social Security account is less than the program costs. And that means that this Social Security account is being depleted. They published in their annual report, this is again the Board of Trustees of the Social Security Administration Program, that the fund will be depleted by 2035. And they have published this actually for multiple years. Every year they adjust what date they think it will be depleted. 2035 has been the date for the last 2 years. And so this is the projected depletion date for the fund. When it does become depleted, that does not mean that the program ends. What that means is there's no account there. There's still tax dollars being contributed. And so you can take those tax dollars and continue to pay Social Security benefits from it. But what they're forecasting right now is that they would only have enough income from Social Security taxes to pay 79% of the scheduled amounts if there's no reform. They basically are publishing on an annual basis that they do not have enough money to deliver on their promises. And so they've been publishing this for many different years. Again, 2035 for some people feels so far into the future that they're not accounting for it. It's going to come fast. It's going to come really fast in terms of how long that 10 years takes to pass. But this is, again, public domain being published by the Board of Trustees. So what happens if the funding count goes to zero and benefits cannot be covered by tax payments? Well, there's a couple of adjustments that they potentially will make. They may make one of these or they may make all of these, and time will tell what they decide to do. I personally am in the camp that you will see at least one of these adjustments, if not multiple, to Social Security in our lifetime. Something's going to change. We'll start with one of the adjustments they can make, which is increasing the full retirement age. For younger workers, people farther away from retirement, it's very likely that they'll push FRA back. They've already done this. As I mentioned at the beginning of this call, your FRA date depends on when you were born. So it may be 66, it may be 67. The people who are age 66 are older. What ended up happening is the government had a promise to pay them in the Social Security Administration program. They realized they're not going to be able to fulfill that promise. But for that cohort of people, they said, all right, we're going to keep your birthday at 66. But for people that are younger, we're going to bump it up to 67. Effectively, we're going to break our promise to those younger people and we're going to pay them later. They've already increased FRA once. It's extremely likely they're going to do it again. So I would suspect for someone my age or in between me and retirement age, I wouldn't be surprised for FRA to get pushed back again. That reduces the strain on the program because you're delaying, you're just basically paying people less between now and when they were to pass away. So increasing the full retirement age reduces the strain on the program. A second thing they can do is decrease the cost of living adjustments. So if you're unaware, Social Security payments are indexed upwards at the rate of inflation every year with COLAs or cost of living adjustments. They might start using an alternative measure for how they adjust that up, and it would be less. So, for example, Social Security payments saw really large increases through the inflation we saw in the last 3 years. Up until the most recent year is a relatively small adjustment. But rather than giving that 8% adjustment for inflation when times are difficult, they may actually say, all right, inflation was 8%, but we're going to cap the COLA adjustment at 2. It can't be more than 2. What that effectively would do is your Social Security payment would be going up 2% per year. So it feels like the check's getting bigger. But in real dollars, you're getting paid less. And inflation is eating away at your ability to live off those Social Security checks. So that's another way the program could change. They can increase payroll taxes. That probably will also happen. Two ways they could do that. They could just raise the FICA tax rate and how much you pay. Or they could also increase the wage cap. Right now, I think it's 168,500. You're taxed on everything up to that. If you earn more than that, you don't have to pay FICA on anything past that. They probably will bump, they have been bumping that up. They may aggressively bump it up so that high income earners are paying more into the payroll system, would be their goal there. They may just flat out decrease benefits. I think that's actually far less likely. I think they'll increase the age, adjust the COLA, increase taxes. The other thing that they could do, and I would not be surprised to see this impacting people on this call, would be doing means testing at some point. And that would be where they take a look at your overall net worth and they test your means and say, if you have a net worth over a certain amount, we're going to reduce your benefit. The Social Security Administration program actually already is indexed that way, where those that contribute the most get the least amount out of the program based on the way the graduated system works, but it may get more aggressive. So confidence in the program is something else that could impact your decision on when and how to claim. If you think the program is going to be adjusted, not in your favor, that could be a reason to potentially claim earlier. Framework number 3 on a way to think about claiming Social Security is health and lifestyle. This has nothing to do with the program and nothing to do with mathematics. One of the things that we've observed building hundreds of financial plans for families over the years is that your health and vibrancy and energy and spending, your overall spending, is higher when you're younger. There's no surprise there. And so for some people, when they're thinking about timing of Social Security, and they say, do you want to try to maximize your overall net worth when you're 90 years old, or would you rather have cash now when you can travel? And I do think it's a perfectly valid framework to not try to mathematically optimize your Social Security, but rather take payments when you need them based on health and lifestyle choices. So, for example, take the payments when you're young and travel. What we've seen time and time again is that when people retire, more often than not, their retirement spending goes up. When they're younger, they're traveling more activities, they're eating out more, they have more free time, and they end up with more hobbies. When you're working, it actually has a way of making you spend less money because you have 40 hours in the office, right? When you retire, it tends to go up. But then what also happens is the later you go into your retirement, that spending comes down, 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 down. And by the time you're 85, 90 years old, really budgets get extremely small because people don't want to do anything. And so when you look at health and lifestyle in terms of when you have energy at this age and stage of life to do the things that you love, and when do you have these cash flow needs, that's a perfectly legitimate framework also for trying to determine when you need Social Security. And framework number four, these are a bit more advanced in terms of claiming topics, going a bit beyond the basics. We'll talk about four today, but there are many that could potentially pop up. I'm sure there's people on this call with really unique situations that would fall into this category. But if you're married and you have a spousal age differential, that creates a unique situation. We'll talk about that here in a minute. Divorces and survivor benefits create really unique situations where there could be really obvious claiming strategies that are more valuable based on your marital status. Roth conversions can have a big impact on when and how you claim Social Security. And then we'll talk a little bit too about some wet provision changes in 2025 for those that are impacted by it. But we're going to start with spousal age differential strategies. This is perhaps not most appropriately named. I named it spousal age differential, but really what you're looking at here is a difference in life expectancy. Okay. When you have a large difference in life expectancy, there's some really powerful strategies that you should implement. And we're going to talk about one right now. So let me lay out what we're looking at here. The scenario that we see most commonly with clients that we work with is oftentimes there is a higher earning spouse that has a work history, and then we see instances where there is a lower earning spouse that may not have a work history. And we've also seen age gaps between those two. And in the situation for many of the clients that we serve, oftentimes the man is older and the woman is younger, and the difference may be 10 years in age. This creates a really unique situation because women have longer life expectancies. And in this instance, the spouse is 10 years younger as well. So the probability of her outliving her husband is very, very, very high and may outlive by a very substantial amount of time. When you see a situation like that, where life expectancy differences are very large, one of the more advanced strategies that is very beneficial would be for that higher earning spouse to delay their benefit as long as possible, and for the lower earning spouse to begin claiming their benefit immediately. The reason for that is when the higher earning spouse delays their benefit, it continues to increase. The lower earning spouse is going to claim immediately. The reason that you do that is a thing called spousal survivor benefit. When the higher earning spouse passes away, which is likely to occur first because they're older, when they pass away, that the other spouse will step into their Social Security benefit and they'll receive that for the rest of their life. So we talked about this break-even analysis previously, and that was really for like one individual, right? The break-even was around age 84. In this instance where you have a 10-year age gap or more, what can end up happening is the older spouse passes away and then the younger spouse steps into their benefit and they may receive that benefit for another 20 years or so. So what ends up happening is the time horizon for that increased payment can be really, really long for the younger spouse. So delaying becomes very, very valuable because they're going to have that benefit for a long time. The reason they claim immediately is because they're going to step into their spouse's benefit anyways. So they should go ahead and take the penalty and claim. And when their spouse ends up passing, they step into that benefit. So this is one of those instances where the break-even analysis is a lot more complex and there's a lot more moving parts, but the difference can be huge in terms of how much that married couple receives over the lifetime of Social Security benefits. So that's a big difference in terms of those. This actually would apply though where there's any large difference in Social Security benefit and life expectancy. That would be the big takeaway, I think, from this slide, and it's really worth analyzing and doing that correctly. There's hundreds of thousands of dollars on the line in terms of setting that up appropriately. The next one that gets a bit more complex are people that have been through a divorce. So if you've been through a divorce, depending on the work history of you and your ex-spouse, you may be able to claim up to 50% of your ex-spouse's benefit if your marriage lasted for more than 10 years. And just as a fun fact, your ex-spouse will not be notified or affected. It doesn't impact their benefit at all. You just basically are allowed to claim spousal benefits even though you're no longer married. The same is actually true if your ex-spouse were to pass away. You are eligible to receive 100% of their benefit if theirs was higher than yours, even if they had remarried. That does require 10 years of marriage, and you can't get remarried uh, under the age of 60. But these are some scenarios where the benefits can change in divorcial relationships. One of the things that's challenging about this, I put in this bottom left-hand corner here, is hidden entitlements. No one is going to tell you at the Social Security office that your ex-spouse has passed away and you are entitled to thousands of dollars more per month. No one's going to do that. So you actually have to check this proactively and inform the Social Security office if that were to occur. It's a little bit of an awkward exercise because you're very likely reading obituaries in a certain jurisdiction to check to see if you're entitled to any higher Social Security benefits. But this is a hidden entitlement where you could be eligible for thousands of more dollars and you're unaware of it, or you haven't checked, or you have not notified Social Security. Another thing that's really important with this is people that are considering getting remarried. If you are on an ex-spousal benefit and you get remarried before the age of 60, it can impact or eliminate the benefits you are currently receiving. So if you're considering that in a situation, I would highly recommend either reaching out to us or looking into the rules for this, because waiting until after you're 60 to get married versus getting married prior to 60 can have a pretty big impact on your Social Security benefits throughout the remainder of your lifetime. So this one is complex. Again, we touched on like four small ones here. This can get way more complex in terms of how to do this strategically, but it's another area that we see often and is very relevant to many different people. Another area I just wanted to touch on briefly. In 2025, there's been a major legislative change where they're eliminating the windfall elimination provision. They call that WEP for certain portion of employed workers, particularly people that worked for state and local governments like teachers, firefighters, police officers. The way that those pensions have worked historically is if you were a teacher here in Colorado where I'm located, you were contributing to Colorado Para, which is a retirement program here in our state. Because you were contributing that, you were not contributing to Social Security over that time period. The way that this used to work was you would not receive Social Security benefits, or I should say there's an offset in how much you receive in Social Security benefits based on how much you contributed to your state program. So the teachers that we serve here in Colorado, they actually had much smaller Social Security checks because they also got para checks. This was actually eliminated here in 2025, retroactively going back to January of 2024. This is a really big deal for a lot of covered classes of workers because you're entitled to larger Social Security payments, no impact on your current pensions from your state programs or whatever it may be, and you may receive a check going back to January 2024 to get reimbursed for the payments you missed for that entire year. So this is a major change in 2025. If you fall into one of these working categories and you are unaware of it, very valuable information and worth looking into and potentially applying for. So that's another one I wanted to just touch on because it's new here in 2025 and a pretty big deal for a lot of people that are covered. Last but certainly not least, I think is, yeah, on our Social Security, more advanced strategies, we're going to talk a little bit about Roth IRA conversions. Many people that we work with are simultaneously contemplating Social Security timing and Roth IRA conversions. And there is some complexity in how the two of these things interact together. Oftentimes, you have very low income after you retire until you hit RMD age, and those RMDs end up kicking in. And during those low income years, you're considering two things. Should I start my Social Security and should I be doing Roth IRA conversions? Analyzing this is relatively complex, but there's one topic that I really wanted to emphasize because we have seen many prospects that are looking for an advisor. If they're speaking to other advisors and the other advisors are getting this wrong. And so it's really important to understand this concept. When you are collecting Social Security, how much your Social Security is taxed depends on your income. There's this idea here at the bottom called provisional income. If your income is below 25,000 as an individual or below 32,000 as a couple married filing jointly, your Social Security is not taxed. And then it becomes gradually taxable as your income increases beyond that provisional income threshold. The reason this is really important is it is very, very plausible to be a high net worth individual with several $1 million in retirement. You retire, you don't have a pension, you're not on Social Security yet, and you're drawing from a checking account for the next 12 months. And your provisional income is actually below that threshold, meaning if you claim Social Security, there's a potential for none of it to be taxable or taxed at a very low rate. The issue we've seen when it comes to Roth IRA conversions is we have seen people turn on their Social Security when they're below the provisional income threshold. Then an advisor tells them, oh, you should do a Roth IRA conversion and fill up the 12% bracket because the 12% bracket is a low bracket. And you want to take advantage of this low bracket. And they say the taxes that you're paying is 12% plus state. That is inaccurate. And it's really important to know that because what ends up happening when you do that, your Social Security income goes from not taxable to taxable up to 85% when you go to perform that conversion. And what looks like a 12% conversion actually can work out to over a 23, 24% effective tax when you factor in the Social Security. So Roth conversions and Social Security timings have an interplay that is a lot more complicated than it appears at face value. So I just wanted to mention that one as well. If you're considering doing Roth IRA conversions while collecting Social Security, you need to be aware of how it actually impacts your taxes on the conversion side. So that's a really high level of some of the more advanced topics. Obviously, we could dive into far more depth on any one of these, depending on how it impacts people. But with that, I'm going to go ahead and open it up for some Q&A.
Awesome. Thanks, Chris. Yeah, we totally realize that not everyone's situation is the same, and it's impossible to have a single webinar that addresses all of your all situations. So before we jump into some Q&A, I do want to just give a quick reminder of the free strategy session we're offering for limited number of those for really us to just learn about your situation, provide valuable recommendations, and address any questions that you have. So I will drop a link in the chat one more time. You should have seen like a chat bubble up here. You can just click that link. A calendar interface will show up. You can pick a time, and we'll be on our way. So, Chris, I have a couple interesting questions here.
Shoot.
So you mentioned 4 different frameworks for how you can approach claiming. What's your
Yep.
personal favorite?
That's a really good question. And full disclaimer, definitely have opinions about this personally. So there is break even, which is mathematical approach, confidence in the program, lifestyle choices, and some of these advanced strategies. For me, and usually the recommendation that I make to clients, in most scenarios, but not all, is to claim early. The reason for that is when you do that break-even analysis, it assumes the program's going to stay the same. When I think about my confidence in the program, I think that the program will either stay the same or get worse. I do not think it will get better. So when you look at doing that break-even analysis, say break-even is around age 84, if everything stays the same, right? The probability that it's actually worse than that, I think, is reasonably high. I mean, they're publishing information every single year that says we don't have enough money to support the program. It's in public domain. You can read it. People just are ignoring it. But that's an argument for claiming early is program confidence. Health and lifestyle, which has nothing to do with money, Claiming early lets you travel more during those years when you have health, energy, and the willingness to do it. So, out of all three of those, I personally lean towards claiming early in all three of those categories. Now, the fourth one, advanced strategies, that actually overrides the rest. If there's like a spousal situation, like I mentioned about the life expectancy gap, mathematically you would set it up that way where you have one person delay and the other person claim early because it's overwhelmingly positive for the surviving spouse in that situation. And so, apart from the advanced strategies, I personally lean towards claiming early. It's my personal preference, and but again, there's different frameworks for approaching it.
Awesome. Great. Next one. What if I accidentally filed too early? Is there anything I can do to change or reverse my decision?
Yeah, good question. It's not super trivial. You can do it. So from the time that you claim, you have 12 months from the date that you made that claim to basically reverse it. So you can retract that. The issue with that is you do have to pay back the gross amount of receipts that you had. So most people, when they think of their Social Security check, they see a net number, right? Usually Medicare is subtracted from it, taxes are subtracted from it, and they'll say, oh, I'm getting $2,000 a month. If you claimed early and 4 months later decide you don't want to do that and you have $8,000 on cash you received, you're gonna have to pay that back, but not the $8,000, right? That's the net amount that you have. You have to pay back the gross amount, which is after Medicare and taxes. So you're gonna have to write a check back to the government to reverse that. We don't see that often, to be frank, where people end up reversing Social Security decisions, but it can be done up to 12 months from the day that you initialize it.
All right. Just one more here. It's kind of long because it talks about a bunch of specific details. So I'll leave those details out and just ask at a higher level. If I claim my benefit early, those are more those are now like more dollars that can indirectly or directly grow in an investment account.
Yeah.
And so how should that effect of compounding kind of impact how we think about the break even analysis versus just a dollar to dollar comparison?
Yeah, that's a fantastic question. And actually, when you get into a break-even analysis, for 90% of the people, the compounding of investments that you don't have to touch needs to be a part of that equation. And so the way that you would factor that in is you would have some expected return of your portfolio. You would take those social, if you remember the way I had set it up, we just took the gross Social Security dollars pre-tax and looked at like a break-even number. What you'd actually want to do is after-tax amount and then compound that at whatever your portfolio rate of return is estimated. You do that for every single year. And that lump sum that you're receiving on the break-even analysis will be growing because it has some type of rate of return associated with it. What that will do, bottom line, as long as your investment return is a positive number, okay, it will push back the break even age. So what we were looking at with this gross number with no compounding at all has a certain break even age. If you are investing that money or leaving other money invested longer because you don't have to draw on an account because of Social Security, it's going to push back your break even age. And so that's the short answer is yes, you should factor that in. And yes, it pushes back the break even age, assuming your investment return is positive, which hopefully it is.
Perfect, perfect. There's a couple more here, but I want to make sure we respect everyone's time. Really appreciate you guys coming out today. Hope it was valuable. Again, one last time, I'll drop just sent it, the strategy session link there in the chat. You should see a little bubble show up and you can click that. If you have any questions, feel free to shoot us an email, give us a call if you want to just learn more about how the firm works. Otherwise, we'll love to chat with you in those strategy sessions and help you with your situation. So have a great day.
Wonderful. Thanks, Robert.